Welcome back to Strongman Personal Finance. We got a sponsored video today, and if you want a sponsored video, you can send me $50. See the pinned comment below. We're going to react to this video on the Rational Reminder podcast, Mr. Ben Felix, where Michael Green, market efficiency is not the question. So once again, we have a hedge fund active manager guy giving evidence that markets are not efficient. And the market's in a bubble, massive index bubble. Indexing is distorting the market. And obviously, the conclusion is you should put your capital or your money. I like to say money, not capital. You should put your money with an active manager because they're not just dumbly buying stocks based on their current valuations. So let's hear a brief part of this. And then I don't think this guy is dumb. I'm not saying he's stupid. But we're going to watch a brief part of this, and I'm going to just give you my thoughts, okay? So we know Ben Felix on the top right, Mr. PWL Capital. We know that, I don't know who that bald guy is on the bottom right, Mr. Cheek Clapper. And then we have Michael Green, who's the big one. So let's hear what Michael Green has to say.
Increase the proportion of markets that are true, the proportion of market participants that are truly valuation insensitive, right? Or price insensitive is another way to think about it. And as a result, what you've done is you've actually increased the inelasticity of the market, the ability for prices to change in response to relatively small changes in supply and demand. That's really the primary dynamic. You removed that historical filter in which investors would react to higher prices by saying, all else equal, the information content that I've now received is that future returns will be lower. Therefore, I'm more willing to sell. For passive investors, you actually receive the opposite signal. As the price goes higher, relative to other securities, it becomes relatively more attractive. It's presumed that there's information content there. And as a result, you actually allocate more capital to those names that have gone up the most.
I think I don't really like what he's saying there. When a stock goes up, I mean, sometimes you got clown stocks that briefly go up, temporary market fluctuations, idiots buying calls, whatever. I'm talking about long term. On average, the average stock that goes up. When a stock goes up, it's generally, well, obviously more people are buying the stock than selling it. But generally, it's because the active participants in the market have realized that this company's future cash flows, this company's future profits are higher than expected. The market comes and prices that in to the stock price. That's why the stock price goes up. So by buying the stock at a higher percentage of your, monthly purchase or biweekly purchase, you're buying it exactly where the market is determining that stock should be priced based on the expected future cash flows, future earnings discounted by the weighted average cost of capital or whatever. That's basically the concept, okay? Just because a stock goes up, I mean, I guess theoretically, yeah, the expected future returns go down, but it's also going up because the future returns are higher. They're expected to be higher. That's why stock goes up. Obviously, besides the short-term mechanics of more people buying than selling. You're not buying, okay, these companies that go up a lot, they go up a lot for a reason, okay? And the market's constantly pricing in new information. And when they go down, the market's pricing in generally bad information. And that happens so very quickly that you have a hard time keeping up, okay? But basically, what he's implying is you're buying stuff that goes up a lot, and, you're buying less of stuff that goes down a lot. Yes, because you're assuming that the market is efficient. On average, you're looking at the market. Everybody else looks at the market. You're not the only market participant. Security prices are set by everybody in the freaking market, okay? It's the equilibrium price that is set by all the participants that collectively know all or most of the information. That's it. That's indexing.
So what does the ultimate bad outcome for this issue look like?
Well, unfortunately, the way this plays out is that it looks like things are getting better and better and better and better. It's very much like the turkey, Caleb's turkey before Thanksgiving, right? Where it looks like it's most robust, where it looks like it's most richly valued, where it looks like the opportunity set is greatest, is right before actually you end up seeing a net redemption that plays the whole thing in reverse. Right? Just makes the market much more fragile in both directions. That's really the definition of inelasticity, right? A market that reacts, a price level that reacts much more violently to small changes in supply and demand.
Yeah, okay, perfect. That's what I was going to ask you to clarify. So when inflows are going in, that's having an upward effect, but when they go down, it's going to have an exacerbated downward effect.
Exactly correct.
Okay. Can you talk about the XIV trade that strengthened your belief in this view?
Sure. So XIV had a couple of different components to it, and I just want.
Okay, so basically the purpose of that is, well, what he's saying is there's, when there's going to be net redemptions, there's going to be a violent drop in the market. And my response to that based because indexing, because when indexing, when a bunch of flows are passive, they're all going to the top companies, and when the market drops the most, all the redemptions hit the top companies the fastest. Whatever. Okay. At the end of the day, my question to you is, if that does happen, why do you care? If you're investing for 30, 40 years, it does not matter if there's even if there's a temporary bubble. It doesn't even have to be an index bubble. It doesn't matter. It doesn't matter at all, okay? In the next 40 years, I assure you the market is going to be pretty efficient, and even if there's wild fluctuations, in the long run, I think we're going to get the average return that the market gives, okay? All the collective participants in the market, in the aggregate, get the average return. What you want to minimize is fees. That's it. That's index fund investing, okay? Now, Michael Green goes on to say that this is most pronounced in the United States. U.S. stocks, bro. Basically, all the passive flows, everybody buys U.S. stocks, okay? Everybody buys the SPY. Everybody buys VOO. Everybody buys QQQ. I've noticed that myself. You know what I have that mitigates the risk of an event where there's a huge crash in stock prices because of index bubble? I'm globally diversified. Okay, people laugh at me because I don't buy stuff that just goes up. I buy everything because I assume it's all priced as the market expects it to be. If you're globally diversified, you're dollar cost averaging, and you're holding in a long time horizon, you're going to be fine. If you need money in the next couple of years, maybe it shouldn't be in stocks. Maybe it should be in like cash or CDs or SGov or something. Okay? And on top of that, let's say, there are active managers out there that are going to beat the market. Of course there are. Because, statistically, some people are going to beat the market, obviously. Some are going to underperform, some are going to outperform. Okay? But you can't pick the guys, or you can try, but it's going to be hard to pick the guys that perform well in the future because you have people that do insanely well in the past. They get their heads swollen because they think they're geniuses, and then they get absolutely wrecked in the future. Even if their indexing was not the optimal strategy, even if you were super convinced we were an index fund bubble, who would you choose instead? Most of the active managers do this. They just closet they closet index. They just follow the index. Instead of Apple, Microsoft, Nvidia, they do Nvidia, Microsoft, Apple. They just shuffle around the top holdings of the U.S. markets. It's a bunch of nonsense. Okay? And this guy, Michael Green, he works for the Simplify. I just made a video about SVOL. Okay, it's like I don't even know what the hell they do. It's just a clown show. But if you look at, so obviously, his career has been in like hedge funds and working for Peter Thiel's investment firm. And these people are all about active management so they can charge you fees. That's how they buy their expensive suits. Look at all these freaking things that they have here. So Simplify MTBA. What is this? What's the expense ratio on this? Okay, nothing crazy. 15.15. But some of these have decently high expense ratios, like SVOL. This Simplified Volatility Premium ETF has an expense ratio of like 1.16%. Okay, that's the gross expense ratio. That's pretty freaking high. Okay, they do this because they don't want you buying the index because their jobs would be useless. That's why they do this kind of stuff. Okay, so no, I think this is BS. So the guy that requested this, he said, Ben Felix, maybe agree with him. Look, even if there was an index bubble, which index? People buy index funds, but there's 1,000 different index funds. The market is not inefficient in the aggregate overall. Okay, you got clownery, whatever. It's fine. You're going to be fine. Relax. Think about long time horizon. The more you watch financial news, the more they're going to scare you. And you're going to make stupid decisions. What are you going to do? Invest with Michael Green here and buy SVOL or whatever he freaking manages? What are you going to do? You don't know. Okay? It's better just dollar cost average in the global index, call it a freaking day. never watch the financial news because they are always incentivized to move you from the index because they want to make freaking money because they can't do it. They suck at accounting and they washed out of accounting. And so they went into finance and investing. Okay? It's as simple as that. So I don't think Ben Felix thinks there's an index. So I honestly, I think, he asked about U.S. expected returns and he addressed it. Basically, some people are calling U.S. stocks to not do well in the future. Who freaking knows? Okay? Either way, I'm fine. Either way, I don't really give a crap. But I don't think Ben Felix thinks there's an index fund bubble. And if he does, he preaches global diversification. Now, he talks about small cap value. Waste of freaking time. Just buy VT. Not financial advice. Okay? But just because Ben Felix says something, I don't care if Ben Felix says something. I don't care if Michael Green says something. The most optimal strategy for me is to buy a global ETF, knowing that there are active market participants setting prices. And if I dollar cost average over time, I'm probably going to get a decent price for all the stocks in the world. Okay? That's my video. Hopefully you enjoyed it. Hit like, subscribe if you want a sponsored video. See the pinned comment, $50. $75 for a one-on-one tutoring session for accounting. I don't do stock predictions. And buy my book, Stop Being a Broke Loser. It's on Amazon. Cheers.